Hi, I'm Thomas. Welcome back to the course Corporate Finance. Today's lecture is on debt capital. Debt capital comes from two general sources. One is private, which refers to direct lenders, either through a private placement directly between a borrower and a company that is investing through a loan or a debt to the company, or through bank loans by going to a bank to obtain a loan directly from the bank. Public debt is obtained through investment banks doing an underwriting and generating interest from the public to invest in the bonds of the issuer. And the bonds in the primary market are issued by the issuer. The issuer receives proceeds, and the investor now is a lender to the issuer. In the secondary market, an original investor can sell their investment in company bonds to another investor, and just as we discussed in equity capital, that will not directly affect the issuer. The issuer won't participate in that transaction. And regarding public debt, the concept of bond trading, as we're discussing in the secondary market, relates to bond yields. In the concept of bond yields, which we won't cover in this topic, but bond yields refers to the fact that as the bond price goes down, the yield goes up. A bond has a fixed interest payment, generally twice a year for some number of years, and that is set. So the lower the price for the bond, the higher the yield. And the higher the price for the bond, the lower the yield. So while a bond has a fixed interest rate, the market rate for that particular company isn't going to stay the same. The rate might change, the required rate of return might change, or the risk profile of the entity could change, and those factors are going to affect the required yield in the market to invest in the bond, and that required yield will affect the price, again in an inverse relationship. The higher the yield, the lower the price, and the lower the yield, the higher the price. Debt covenants are requirements by the lender that a borrower or an issuer must follow. Secured versus unsecured debt. One requirement of debt financing might be security. A common example is a mortgage. When an investor, whether an individual or a corporation, buys real estate, if they use debt financing, usually the debt financing is secured by the real estate, so that if the borrower does not make a payment on the loan, then the lender can take legal action to eventually take the security, in this case take the building, from the owner for non-payment of the debt. If debt is unsecured, then a lender isn't able to take a particular asset because there isn't a particular asset backing that loan. Restrictions. Debt covenants might restrict a borrower from either issuing new debt, borrowing more money, increasing leverage, thus increasing risk, or perhaps restrictions could be against dividend payments. A lender might want to make sure that the cash flow is stable and strong for the company such that they are paying their interest before they're paying any dividends. So there might be a restriction saying for a particular period, maybe the entire life of the loan, there can be no dividend payments, or dividend payments might be restricted until a borrower reaches a certain cash flow level or certain ratio requirements. Those are examples of restrictions. Accounting ratios relating to debt covenants. The debt to equity ratio, the lower this ratio, the more conservative and lower risk the borrower. So a lender might have a maximum, a cap on the debt to equity ratio, such that if the debt to equity ratio were to exceed that level, then the bank would say, possibly, the loan is due. Your risk level is too high and you need to pay the loan back in full. The current ratio is the ratio of current assets to current liabilities, which is an indicator of a company's ability to meet its current obligations due in 1 year or less. The higher this ratio, the better. So a bank might have a floor below which this ratio can't go. If the current ratio were to go below a certain level set by the bank, then the bank again might be able to accelerate the loan payments, and say to the borrower that the loan is due. Finally, debt service ratio is EBIT, earnings before interest and taxes, divided by debt service. Sometimes this is calculated as the interest coverage ratio, earnings before interest and taxes divided by interest expense. But in the case of an amortizing loan, the loan has an interest payment requirement as well as a principal payment requirement. And the debt service ratio gives a more complete picture of a company's ability to make that debt service payment. The bank here is looking for a minimum level. The higher this ratio, the better. So the bank would be looking for a minimum level or a minimum ratio for the company to be at. And if they were to go below that ratio, the bank could again perhaps accelerate the loan and say that the loan is due in full now as opposed to at the original loan date. As very rough examples, depending on the industry, depending on the company, we could say that a debt-to-equity ratio, we wouldn't want to see this number greater than 1.0. Beyond 1.0, debt is greater than equity. The current ratio, we wouldn't want to see this number go below probably 1.5. Once we go below 1.5, we're getting into a situation where current assets are getting close to the same amount as current liabilities, and we don't have enough cushion to cover our short-term obligations. And the debt service ratio here, a nice number is 5 times. In other words, EBIT should be at least 5 times debt service. Going below 5 times, depending on, again, the bank and the company, might be a situation in which the bank senses that there's some potential risk in the borrower's ability to make its debt payments. Let's look at an example of debt covenants. A company that currently has $400,000 of EBIT and a loan. Currently, the loan amount is $1,200,000. The interest rate is 5%. And the bank's debt service coverage ratio requirement is 4 times. So this bank is a little more aggressive and allows the ratio to be as low as 4. Now, the question is, this company is interested in borrowing an additional amount of money. Current interest rates are 8%. What is the additional amount that the company can borrow such that the loan payments they're going to make, which are going to increase total debt service, won't create a situation in which the debt service coverage ratio goes below 4? And in our solution, we see that with an EBIT of $400,000 and a debt service coverage ratio of 4, the maximum debt service is $100,000. In this scenario, we're assuming interest only, no principal payments, interest only, and at a 5% interest rate, the current loan of $1.2 million incurs annual debt service, annual interest payments of $60,000. With a maximum debt service of $100,000, there's $40,000 of additional debt service potential, and at an 8% interest rate, the loan amount that would result in a $40,000 interest payment, which is $40,000 divided by 8%, is $500,000. So this company could borrow another $500,000 at 8% on top of the current loan at 5%, and the total debt service would be $100,000, which would meet the requirement of the bank of a debt service coverage ratio of 4 times based on EBIT of $400,000. Next, callable bonds. Callable bonds are bonds which, at the option of the issuer, at the option of the borrower, can be repurchased. Now, a lender doesn't want this to happen generally. If a lender has a loan at an interest rate that, because of changes in the market, is high, that's good for the lender. High interest rates mean high interest income. But bad for the issuer. And the issuer, if they have the option to call the bond, might decide to pay the bond off early so that they can get new financing at a lower interest rate. They'd have to pay a fee to do this. The terms of the original bond issue would describe what the callable scenario is, what the features of the call are, but there's always some premium payment attached to this privilege. For the issuer, it's a benefit. It adds flexibility. From the investor standpoint or the lender's standpoint, it's a negative. It is a situation in which they might be earning a nice yield, a nice interest rate, and as market rates move down, the borrower might pay off the loan, and now the lender loses the opportunity to be invested at that high rate, and they get their cash back and now have to go invest in new investment at a lower yield in a market in which rates have come down. So in order to accept a call feature in a bond issue, an investor or lender will require a higher yield on that bond than a bond without the call feature. Let's look at an example. A borrower has bonds outstanding of $10 million and the interest rate is 7.2%. Since the time of issue, interest rates have come down. Now, the current market rate is 5.8% for this company. This bond has a call feature. It is callable at 101. That means that the issuer, if they will pay 101% of the face amount of the bond, they can call the bond early. It's not due for 3 years, but for this premium payment, they can call the bond early. If they issue new bonds, they'll issue at the new market rate of 5.8%, and they will pay fees of 3.5% of the bond issue. So, should the issuer call the bond, in other words, pay the bond off early, and issue new bonds? Just one quick edit. You'll notice now that the fees have changed to 2.5%. So instead of 3.5%, we're going to complete the analysis with issuance fees of 2.5%. Let's proceed. And here's our analysis. We want to look at the amounts that change comparing the current and the new scenario. Currently, the bond is $10 million. The new bond would also be $10 million. The interest rate currently is 7.2%. Annual interest times 3 years, because we're looking at a current bond that has 3 years of life left, so we want to take the full 3 years into consideration. 3 years of annual interest is a total interest amount of $2,160,000. Under the new scenario, 3 years of total interest, because of the lower rate, would be $1,740,000, and interest for the 3-year period would decrease by $420,000. Now, the call feature requires the premium payment of 101. That means a 1% premium on the bond face amount, or purchasing at 101% of the bond face amount. So the additional amount to pay would be $100,000. And the new issue would require fees of 2.5%, which results in a fee amount of $250,000. So for the change analysis, interest goes down by $420,000. The premium requires an additional payment of $100,000. The fees for the new issue require a payment of $250,000. And the net decrease in cash outflow is $70,000. The savings on the interest payments more than offset the premium payment as well as the fees on the new issue. And the decision for the company would be to do the new issue. Call the bond, pay the premium, issue new bonds at a lower interest rate, pay the fee for the new issue, and over the 3-year period, the net result will be a decrease in cash outflow, or a cash flow savings to the company of $70,000. Now let's look at the concept of convertible bonds. Convertible bonds can be converted from bonds to common shares, or in general terms, from debt to equity. So a lender, by converting, would become an owner of the company. The conversion price, you want to be able to calculate the conversion price per share of the bonds so that you can compare that stock price to the market price of the common shares of the issuer. And the calculation is the face value of the bonds divided by the number of shares into which the bonds can be converted. So, as an example, what is the conversion price of a $100,000 bond, which is convertible into 400 shares of stock? That is $250 per share. We divide the face amount of the bonds by the number of shares the bond is convertible into, and we arrive at the stock price of $250 per share. Now, what does that price tell us? When the conversion price is higher than the stock price in the market, if we look back at our example, the $250 per share, if the market price of that stock is $200 per share, well, there's no real benefit currently in the conversion. So we would value that bond as a normal bond. There's really no value in that conversion feature. If the conversion price is lower than the current stock price, if in our example the current stock price is $300 per share, and we can convert at $250 per share, then there's value, additional value, because we could convert the bonds and have an investment value of $250 per share, sell the shares in the market at $300 per share, and make an immediate gain. So we would value this bond as if it were already converted into stock. It's essentially valued based on the market price of the shares trading in the market. And a conversion price close to the stock price means there's some uncertainty. You might get to the point where the conversion price is favorable. In other words, the market price goes above the conversion price, or maybe it's already there, but it might not stay there. It might drop down below the conversion price. So when it's near the conversion price, there's some uncertainty. There's potential value. That's very similar to the concept of an option. So we would value this add-on feature like an option. There's a bond that has value because of the periodic interest payment coming into the lender. There's an additional amount of value, which is the potential that the bond can be converted to common shares at a favorable price. Now let's look at an example. A company has a $20 million bond that is convertible into 500,000 shares, and the interest rate equals the market rate. So there's nothing special about the interest rate of the bond. What is the approximate value of the bonds in these three scenarios? Stock price of $25, or $40, or $55. And what we need to do first is we need to calculate the conversion price of these bonds. What is the price per share that equates to the amount of the bond divided by the total number of shares that are or would be received at conversion? Then we can compare that price to these three scenarios to evaluate the bond value. Our conversion price is $40 per share. That's the face amount of the bonds divided by the shares received at conversion. And in comparing $40 to each of our prices, the current stock price of $25 would mean that the bond is simply a bond. There's no special value in being able to get shares for $40 when you can go buy them in the market at a significantly lower price. The bond is a $20 million value because the market rate is equal to the rate of the bond. So it's simply based on the interest rate component of the bond. At $40 per share, we're right at the conversion price. So right now, today, there isn't anything special about that conversion, but there is the potential that the stock price will go above 40. We have our per share conversion price locked in at 40, so there is some value there. So the value would be greater than 20 million, and we could do some analysis to get a more precise value. But for our purposes, let's simply understand that the potential benefit of being able to buy these shares at $40 each when the market price goes above $40 each means the bond is worth something more than $20 million. And if the stock price were currently $55, that's well above our conversion price of $40 per share, so we could at any time convert from bonds to shares with an investment amount or a basis per share of $40, go into the market, sell for $55 per share, realize an immediate gain of $15 per share. So we're going to value this bond not as a bond, rather as the shares, as if they had already been converted due to the significant difference between the current market price and the conversion price. This concludes the lecture Debt Capital. When we're in class together, we'll be sure to give you plenty of opportunity to work through these concepts and make sure you can apply the tools in a real-world setting, and I look forward to seeing you then.